This video is sponsored by Blinkist. Use the link in the description below or the QR code for a 7-day free trial plus 25% off a premium membership. Big short investor Michael Burry sounds the recession alarm, warning the US economy faces a multi-year downturn. Downturn is highly likely, and Fed projections have been horribly wrong, Mohamed El-Arian says. This recession is the next depression. Danger ahead. Meet Kevin. Whether you base your views of the market off of news headlines or apocalyptic finance YouTube thumbnails, a lot of people are growing concerned over a coming recession, assuming that we aren't already in one. And it is easy to see where this concern is coming from. After all, debt levels are very high, interest rates are increasing, inflation is still making things really expensive, and it seems like every major asset group is seeing a sell-off. And it all raises a pretty important question for investors. How should we prepare? Well, genuinely, I know that this stuff can be stressful, so I wanted to take some time to talk about it, to offer up some tips and information, and what investors should consider going into a period of uncertainty. Because as you'll see, what might seem like the obvious course of action when faced with a seemingly imminent downturn can actually be detrimental to your portfolio's performance. So, take a deep breath, and let's go over how to navigate recessions as an investor on today's Plain Bagel. As simple as it might seem, recessions are actually quite a complicated phenomenon. Not only do economists still debate on how past recessions were caused, but even today there's no agreed upon method globally for determining when a recession has occurred. While there is a technical definition of a recession which labels it as 2 consecutive quarters of GDP contraction, the United States, for example, uses a more opaque methodology when determining whether a recession has occurred, whereby a nonprofit known as the National Bureau of Economic Research officially declares recessions based on a multitude of variables, including unemployment. But regardless of the specifics, most can agree that a recession involves a broad, sustained decline in economic activity, often accompanied by a rise in unemployment. That means stores sell fewer goods, jobs become harder to come by, and the markets generally become more pessimistic. Now, recessions are a completely normal, if not healthy, part of the business cycle. They can actually help reduce inflation, deflate asset bubbles, and generally reallocate capital towards more efficient and more effective projects. But for individual households, they obviously suck. And it's easy to see why many people don't feel all that great about what 2023 holds. Between the pandemic, the war in Ukraine, elevated stock valuations, and rising interest rates, we face a pretty nasty cocktail of headwinds. Rising interest rates are especially concerning given how high debt levels have reached over the last decade, with public debt to GDP alone sitting at around 120%. And as this debt becomes more expensive, households, companies, and the government will likely need to de-lever, offloading assets and cutting their spending to accommodate, while capital is likely to be pulled out of those more growth, speculative types of investments. A big reason behind the recent sell-off in crypto markets and tech stocks. So, given that many pundits and YouTubers are now sounding the alarms, lighting the beacon, so to speak, about the coming recession, what are individual investors to do? Well, let's go over some of the obvious options, starting with the extreme example of selling everything, or trying to time the market so that you can hopefully wait out the uncertainty. Now, this can be a very appealing approach for those who are already down quite a bit and really can't bear the thought of losing any more money. But it unfortunately does tend to be a losing strategy. In truth, the returns of the market are clunky, with much of the performance we see being determined by just a few days in the year. So the risk of accidentally missing one of these important good days greatly outweighs the benefit of sitting out some added volatility. For example, if you had invested in the S&P 500 over the last 15 years, missing just the 10 best trading days would have cut your annual return in half when compared to what you would have seen just by buying and holding. And yes, your return would obviously be better if you happen to avoid the 10 worst trading days in the market, but study after study has shown just how difficult trying to perfectly time your trades really is, with Charles Schwab comparing your odds of doing that successfully to winning the lottery. After all, it's impossible to predict how the complex multitude of interrelated variables within the economy will affect your performance, and the data points we do collect are often published with a meaningful lag. GDP figures can take months to be released, meaning that by the time you hear that you're in a technical recession, you're probably already a few months into it and perhaps already on your way out. such as with this year, where GDP in the US saw a strong rebound the quarter after its technical recession. So with timing the market out of the way, let's go over another popular idea: investing in safe havens, assets that earn a return while being uncorrelated to the stock market. It includes things like gold, treasury bills, fine art, and by some accounts, Bitcoin. While we like to imagine safe havens as being a sort of island that's insulated from the stock market, they're more so an in-law suite to the stock market's bungalow. And while they do often maintain a low price correlation with stocks when times are good, crash after crash has demonstrated that when stocks go down, most other financial assets are pulled down with them. Even fine art, an asset group that's seemingly well removed from the stock market, saw a sizable decline during the 2008 financial crisis. Now, there are periods of time when certain safe haven assets have done well when stocks have not, but it's far from a reliable relationship, and one very much challenged and contested by research reports. So while there's no harm in allocating some of your portfolio towards these assets to better diversify your risk, they don't necessarily insulate you from recessions, and they're far from the perfect solution that many make them up to be. Okay, so timing the market and safe havens don't seem to be all that helpful. What about sector rotation? Pivoting your money from riskier sectors into more stable businesses during uncertain times. Well, it is true that there are types of businesses out there, like utilities, that are going to be more recession resistant than other types of business models, like many types of tech companies. But just like timing the market, it can really be tricky to try and sell out of underperforming areas and then buy into outperformers before they have underperformed and outperformed respectively. While you might expect a recession in 2023, for example, tech has already seen a drastic decline in 2022, and it's impossible to know whether next year will be a good, bad, or neutral time for the area. Damn it, Richard, then what the hell are we supposed to do when a recession is on the horizon? Sit around and wait for impact? Well, yeah, actually. Or maybe, it depends. But the point is that you shouldn't build your investment strategy around whether or not we will have a recession. Since World War II, the US economy has had a recession on average every 6 years, with the average length of the contraction being 10 months. For the average Joe, that's a pretty short time frame to be changing your whole approach to stocks. And even if you knew with 100% confidence that a recession was coming next year, making an investment decision based off of that would actually be quite misguided. The economy and the stock market aren't actually all that correlated. In fact, according to a study posted in the Journal of Portfolio Management this year that looked at 15 emerging and 21 developed equity markets over sampling periods of 32 to 120 years, there is no meaningful link between GDP growth and stock market performance. A big reason for this is that the stock market and the economy simply measure different things. There are roughly 4,200 listed companies on US stock exchanges, compared to the 27 million private companies that exist within the US economy, which also encompasses government activity and foreign trade. So clearly the stock market is a tiny subset of that broader thing, the economy. And yes, recessions and bear markets have frequently been seen together in the past, but bear markets have at times preceded recessions, come after the fact, or not occurred at all. And in fact, periods of contraction have frequently been followed by a strong market rebound, given the fact that stimulus measures are often enacted to try and boost activity during a slump, which increases the stakes of trying to call the bottom. And I know, 2023 does seem like it has the perfect layup for both a recession and a stock market crash. But that seems to be the case almost every year. Times are always uncertain. Investors always have reason to be cautious about investing. Over the 2010s, it was high stock valuations and growing debt balances that made people nervous, even though it ended up being the longest bull run in US history. So because no one knows when the next recession will come, and because that wouldn't even really determine how stocks would do anyway, it's sort of silly to make any meaningful adjustments based solely on that type of information. Still, recessions are important and can challenge investors, and I sense your frustration building given how much of a non-answer I've been giving so far. So here are some actual actionable tips for weathering whatever storm lies ahead. The first thing being, before anything else, take a good look in the mirror and analyze your risk tolerance. I know that it's a boring starting point, but your investments will only do as well as you're prepared to allow them. The Dalbar studies have consistently shown that equity investors underperform the index not only because of the shortcomings of active management, but because they often sell at inopportune times. So before considering where to invest, you should decide whether you should be invested and to what extent. And that goes beyond simply how you feel about losing money. You need to look at your financial situation and whether you are able to withstand extended periods of market volatility, such as what might come with a recession. As some general pointers, the younger you are, the more money you have saved, the more you earn, the more secure your job is, an important one during recessions, and the longer that you can keep your money invested without ever needing to withdraw it. Generally, the more risk you'll be able to take on, and the more money you can generally put into the stock market. Once you have an idea around your risk tolerance, you should also review the risk that you're currently taking on with your portfolio to see whether you're investing diligently or more so gambling. If you had all your money in tech stocks over the last 2 years, for example, I'm sorry, but it's hopefully a lesson in why you shouldn't put all your eggs in one basket, especially if that basket is promising that their product is going to revolutionize the world. There's only so many things that will do that. Outside of higher level portfolio diversification between different asset classes and sectors, the items you can look at the individual position level include the company's track record, debt position, cash flow generation, profitability, fixed costs, and more subjectively, the nature of the business and its management. In truth, there are companies that will go under during difficult times, which is why it's important to have a good grasp on the businesses you hold and why you think they'll have no issue surviving a decline in activity. If you don't have that confidence, then you should opt for a more simple, broad-based ETF or index fund approach that virtually eliminates that sort of idiosyncratic risk. Finally, once you've ensured that you're not taking on risk unnecessarily, then you can actually look at taking advantage of market volatility. While it might be stressful to see the positions you hold are falling in price, if you do have faith in the underlying businesses and you have time on your side to wait out the uncertainty, then you face a massive opportunity to buy more of that company at a discounted price. So whether you do this through dollar cost averaging, which is a more systematic approach, or through more active allocations, you may find you actually benefit from the market volatility that comes with a recession. So in conclusion, it's usually not a good idea to be reactive to economic headlines. You're oftentimes doing more harm than good by taking that approach. The best time to prepare yourself for a downturn is before it's happened by applying a consistent approach, whereby you are investing diligently. You manage your risk by owning both stable companies in addition to those more growthier positions, by limiting how much you speculate and understanding what you invest in. And if you weren't being diligent before this time period, then yes, maybe your approach does need some changes. There are a lot of cryptos, for example, that will never recover to their pre-pandemic highs. But if you've been following a diligent investment strategy, you probably don't need to change all that much just because a recession, a temporary recurring thing, is around the corner. The stock market will recover and do well over the long term. So will quality businesses. And having that degree of confidence in your positions really does make going through uncertain times a lot easier. So I have no idea how the market will do next year. And neither do you, nor do pundits. But I do know that proper risk management makes it a lot easier to ignore the noise. So as fun as screaming about the next decline really is, there's a lot to be said for some peace and quiet when it comes to investing. This video is sponsored by Blinkist. From Adam Smith's The Wealth of Nations to Milton Friedman's Capitalism and Freedom, there are a lot of books out there sharing different theories and perspectives on the economy. If you're interested in learning about these different viewpoints, but don't have the time to sit down and read 100 different publications, Blinkist is an awesome service that summarizes nonfiction books, allowing you to either read or listen to the key insights in typically under 15 minutes, making it a great way to learn when you only have a few minutes here and there to spare. For example, I just listened to the Blinks for Narrative Economics, a book by Robert Shiller, who, if you don't know, is the guy behind the CAPE ratio, or Shiller's PE. His book talks about how a lot of economic behaviors are driven by running narratives rather than fundamental trends. One insight I found really interesting was how past recessions influence our behavior for future recessions, such as 1929, which introduced the word crash as a description for market drops. It's a really cool app, and one of the best parts is a new feature that they introduced called Blinkist Connect, whereby you can now split a premium membership between two different accounts. meaning that you can finally share your book summaries and ideas with all your friends who love economics. Okay, well, there is other stuff on there as well, but it's basically a 2-for-1 deal. So check them out. Click the link in the description below or scan the QR code for a 7-day free trial plus 25% off a premium membership. Thanks for watching. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on the topic down below. Do you think that you are well prepared for a recession? Do you think there might be some changes you need to make based on what we touched on in the video? Or do you disagree with any of the points that I've made? I would still like to hear from you in the comment section down below. Thanks for joining me. We'll see you in the next one.